Internal Revenue Service IRS Tax News. Tax Time Guide. IRS reminds taxpayers of recent changes to retirement plans. IR 2021-57, March 16, 2021, Washington. The Internal Revenue Service today reminded taxpayers about the rules for required minimum distributions, the RMDs, from retirement accounts. There's a link to the retired minimum distributions here. Note that when we're talking about retirement accounts, we're talking typically about some type of account that we got a tax benefit when we put it into the retirement account, which could include things like a retirement account with the work, which might be a 401k plan or a 403b plan or something like that, or individual retirement accounts, IRAs, that could have a benefit, may have had a benefit when putting money into those accounts. When we reach the age of retirement, then they typically have the required minimum distribution type of rules. Now, some of these rules may have been adjusted because of the situation that happened last year. So as a part of the relief effort or whatever efforts for the IRS to ease the problems with the coronavirus and related economic problems, there could be changes to the requirement minimum distribution. So we're looking at the tail end of the retirement plans here. When the money then is being required to be taken back out, the IRS typically requires it to be taken back out because it's really a deferral we're talking about. You got a tax benefit when you put it in, meaning typically you don't pay taxes on it when you put it in there. But then when you take it out, you typically have to record it at income at that point in time. If you don't want to take it out, the IRS will typically force you to take it out with a required minimum distribution so that they can tax it at that point. So back to the text. A retirement plan account owner must normally begin taking the RMD, the required minimum distributions, annually starting the year he or she reaches 70 and a half or 72, depending on their birth date and maybe the year they retire. So that means that they start putting money into these 401k plans, and then the IRS is deferring the tax on the money that's going in. And then when you're at 70 and a half or 72, they basically force you to take the money out because they want to tax it at that point in time typically. So retirement plans requiring RMDs include traditional Simplified Employee Pension Plans, those are SEPs, and Savings Incentive Match Plan for employees. That's a simple individual retirement account. That's a 401k, a 403b, 457b, profit sharing, and other defined contribution plans. So the setting every community up for retirement enhancement, the SECURE Act, changed the age when individuals must begin taking withdrawals from retirement accounts. Someone born on or before June 30th, 1949 was required to start getting RMDs for the year they reached age 70 and a half. However, under the SECURE Act, if a person's 70th birthday is on July 1st, 2019 or later, they do not have to take their first RMD, that's the required minimum distribution, until the year they reach 72. The Coronavirus Aid, Relief, and Economic Security, the CARES Act, waived RMDs, required minimum distributions, during 2020. So in 2020, they basically waived them. So seniors and retirees, including beneficiaries with inherited accounts, were not required to take money out of IRAs and workplace retirement plan. The waiver included RMDs for individuals who turned age 70 and a half in 2019 and took their first RMD required minimum distribution in 2020. Individuals who reached 70 and a half before 2020 and were still employed but not terminated employment in 2020 would normally have a 2020 RMD due by April 1st, 2021 from their workplace retirement plan. This RMD is also waived as part of the CARES Act relief. So Roth Iras, now we're talking about the Roth Ira. Remember, when you're thinking about the IRAs putting money into the retirement accounts, you typically have the traditional plan, which is a deferral type of plan, which means you get the tax benefit on the front end, and then they want to tax you at the end when you take the money out, typically, and that would be the reason they're requiring people to take the money out, so that the IRS can then take their portion of the money that they've been deferring for that portion of the time. The Roth IRA is kind of the reverse of that, meaning you put money into the retirement account and then at the end, you're paying taxes on it at the front end. And then when you take it out, then you don't have the same kind of tax consequences as you do with the traditional IRA. So it's kind of like the reverse type of situation. So Roth Iras do not require withdrawals until after the death of the owner. So you can see why that would be the case. That's because they already basically took the benefit, main benefit, or paid the taxes, I should say, at the beginning on the Roth, and then the earnings are not going to be taxed, so you don't have that same tax situation at the end. Whereas in the traditional IRA, the IRS is saying, I would like you to take the money out at retirement, because not because they're trying to force you to spend it. They're trying to say, hey, you should spend it because you're retired. No, they're trying to get their taxes at that point in time because it's more like a deferral type of situation. So the 2021 RMDs, required minimum distributions, individuals who reached 70.5 in 2019 or earlier did not have an RMD due for 2020. For 2021, they will have an RMD due by December 31st, 2021. Individuals who did not reach age 70.5 in 2019 will reach age 72 in 2021, will have their first RMD due by April 1st, 2022, and their second RMD due by December 31st, 2022. So hopefully the managers of your retirement accounts have taken this into consideration. You might want to just discuss it with them to make sure that they're aware of these laws. So to avoid having both amounts included in their income for the year, the taxpayer can make the first withdrawal by December 31st, 2021 instead of waiting until April 2022. So the benefit or the reason that you want to be careful about these types of things is, of course, that when you take the money out of the retirement account, it becomes taxable at that point in time, which is what the IRS wants. But you've got to be careful about that. So you don't want to, if they require you to take a whole bunch of money out, it can increase your tax bracket and so on and so forth. So you got to do the tax planning to make sure that you're taking into consideration the fact that you're going to be forced to pull money out at some point, possibly for the retirement accounts, have to pay taxes on it. So you want to, plan accordingly with any other kind of income that you might have for, to maximize your tax situation, to pay as little as taxes legally required to pay. So after the first year, all RMDs must be made by December 31st. An IRA trustee must either report the amount of the RMD to the IRA owner or offer to calculate it for the owner. Calculating the amount of the RMD depends on the type of the IRA or if they are from multiple accounts. Not taking a required distribution or not withdrawing enough could mean a 50% excise tax on the amount not distributed, which is a severe penalty there. So you want to make sure that you're doing what in compliance with the minimum distribution laws, because they have a pretty high penalty. So some can delay RMDs. So though the April 1st deadline for taking the first RMD is mandatory for all owners of the traditional IRAs, participants in workplace retirement plans who are still working usually can, if their plans allows, wait until April 1st of the year after they retire to start receiving distributions from these plans. Individuals who reached age 70.5 before 2020 and were still employed but terminated employment in 2020 would normally have a 2020 RMD due by April 1st, 2021 from their workplace retirement plan. The RMD is also waived as part of the CARES Act relief. Employees of public schools and certain tax-exempt organizations should check with their employer, plan administrator, or provider to see how to treat these accruals. Coronavirus-related distributions and loans. Once again, coronavirus-related distributions and loans. The CARES Act made it easier to access savings in IRAs and workplace retirement plans for those affected by the coronavirus. This relief provided favorable tax treatment for certain withdrawals from retirement plans and IRAs, including expanded loan options. So note, as part of the relief effort, if you're thinking about a situation when the economy goes down, or a situation where your cash flow goes down, as was the case for many people in 2020, then you might be saying, hey, look, I got plenty of cash. It's just in this thing that's under a retirement umbrella of some shape, either an IRA or 401k plan or something like that. I need the money right now because, there's this big thing that happened. I need to pull the money out. But the government incentivize you to put the money in there so that they can lock it in there, and they penalize you if you pull the money out, even though it's yours. That's the deal. That's the arrangement. But so now, since there's an emergency, one way they can give relief is possibly to say, hey, it's your money. Yeah, you can take it out without us giving you added penalties. Although, again, if you take the money out, it should be taxable at some point, because that was the benefit. You got a deferred tax at some point. So if you take the money out, are you going to get penalized on it? And the other option that you might think, and you might say, hey, look, I got the money in there. If I can't take it out, maybe I can just take a loan against it and use it kind of as collateral to help me get a loan. And again, typically, you're not supposed to do that because that kind of defeats the purpose once again. But due to the situation at this point in time, that could be another kind of relief option to help people get the cash flow necessary during the downturn. So those are a couple things the IRS could consider allowing for emergency purposes. So that's the setup here. So certain distributions made from January 1st, 2020 through December 30, 2020 from IRAs or workplace retirement plans to qualified individuals, there's a link to that here, may be treated as coronavirus-related distributions. There's a link to that here. These distributions are not subject to the 10% additional tax on early distribution, including the 25% additional tax on certain simple IRA distributions. So if you qualify here, remember that the problem is you got this money, but the IRS says you can't, if you take it out, not only are we going to tax you because you were deferred on the tax, this is under normal conditions, because you were deferred on the tax before, but we're going to penalize you with this 10% penalty. So they're saying if you take the money out under these conditions, maybe that would be a place where you can waive the 10% penalty. You want to make sure that you do that and make sure you're in alignment with the rules, and note that your provider knows of those rules, so they give you the proper 1099 or distribution form to the IRS so that you don't get charged with a 10% penalty. So taxes on the coronavirus related distribution are includable in taxable income over a 3-year period, 1/3 each year. So that's the other type of thing that comes into play, because you could say, well, even if I get the 10% penalty waived, I still have to include it in taxes typically, even though it's my money that I earned in the past, because you didn't have to include it in income in the past, because that's the point of putting it into the IRA. That's the benefit. So when you take it out, typically you have to pay taxes on it. But even there, they're going to give a bit of a benefit. They're going to say, oh, you have to pay it and include it in income over a 3-year period, 1/3 each year. And that could lower possibly the overall tax burden, because if you had to pay it all in 1 year, then your tax bracket might be higher. If you spread it out over 3 years, then possibly that'll put you in a lower tax bracket, given there's a progressive tax system. So if affected in the year you take the distribution. So one more time, taxes on coronavirus-related distributions are includable in taxable income over a 3-year period, 1/3 each year, or if affected in the year you take the distribution. Coronavirus-related distributions may be repaid to an IRA or workplace retirement plan within 3 years. So there's another type of thing you might say, well, what if I take the money out now, but I just need it like right now? I'll put it back in. I swear I'll put it back in. If I just put it back in, how about you don't give me any tax or any 10% penalty? Is that okay? And basically they're saying here that you get the coronavirus related distribution may be repaid to the IRA or workplace retirement plan within the 3 years. So you might be able to just put the money back in if you do so within the range period of 3 years. So if you had an outstanding loan balance when you left employment, the plan sponsor will usually offset the loan balance against your benefit. For loans offset in 2020, you have until due date of your tax return plus extensions to repay that amount on other retirement plan or IRA. If you're a qualified individual, you can treat the loan offset as a coronavirus-related distribution and have 3 years to repay to an IRA or include in income tax ratably over the 3 years. So the RMDs, an IRA owner or beneficiary who receives an RMD, required minimum distribution, in 2020 had the option of returning it to their account or other qualified plan to avoid taxes on that distribution. So you might say, well, what if I got an RMD, required minimum distribution, and now you're telling me I didn't need to take the RMD minimum distribution. I won't want to take it if I have the money and I don't need it, because then I have to include it in taxes. So then you might have put it back in to the IRA after you got the distributions, possibly. So they might have gave you a required minimum distribution. You said, hey, I don't need to do it this year. They're not requiring me and I don't need the money. I'd like to put it back in, possibly. And that could end up being a situation as well. So the required minimum distributions in 2020 that were not rolled over or repaid may be eligible to be treated as a coronavirus-related distribution if the individual is a qualified individual. A 2020 required minimum distribution that otherwise qualifies as a coronavirus-related distribution may be repaid over a 3-year period or have the taxes due on the distribution spread over 3 years. So if you got that distribution, maybe you can say, hey, I'm going to call this a qualified coronavirus-related distribution and possibly be able to put it back in, even though it was basically an RMD, required minimum distribution. Little unusual, but you might be in that situation. Take a look at that. A withdrawal from an inherited IRA to a qualified individual may also be a coronavirus-related distribution. Income from a withdrawal may be spread over 3 years for income inclusion. However, the withdrawal may not be repaid to the inherited IRA. So IRS Notice 2020-51, there's a link to that here, provides that the one rollover per 12-month period limitation and the restriction on rollovers to inherited IRAs did not apply to repayments made by August 31st, 2021. So you can take a look at that notice. Typically, you've got that rule for the rollover, meaning a rollover. Typically, when you think rollover with IRAs, means kind of like you're taking the money and you're taking it out of one, retirement type of account and rolling it into another. And you don't want to count that as taking the money out and then putting it back in, but rather just saying, hey, look, I didn't really take the money out. I rolled it over into another set of investments, which are under some type of retirement type of umbrella. So don't tax me or penalize me on that situation, please, because it's still under the under the IRA umbrella. So I didn't really take it out or spend it. But usually you might be limited to that. So let's see it one more time. The IRS Notice 2020-51 provided that one rollover per 12-month period limitation on the restrictions on rollovers to inherited IRAs did not apply to repayments made by August 31st, 2020. The RMD suspension did not apply to qualified defined benefit plans. Okay, so the CARES Act included special rules for plan loans made to qualified individuals. Plans could suspend loan repayment for up to 1 year, although typically repayments resumed in January 2021. This effectively gives up to 6 years instead of 5 to repay a typical plan loan. So if there's a plan loan, there may be some changes or extensions to that type of situation as well that you could take a look at. So IRS online tools and publications can help. Taxpayers can find answers, forms, and instructions and easy-to-use tools at irs.gov. There's links to these items, FAQs, frequently asked questions regarding required minimum distributions, the RMDs, individual retirement arrangements, or IRAs. You might know of them as individual retirement accounts, individual retirement arrangements, IRAs, Publication 590B, distribution from individual retirement arrangements, IRAs, and coronavirus relief for retirement plans and IRAs. So these news release is part of a series called the Tax Time Guide, a resource to help taxpayers file an accurate tax return. Additional help is available in Publication 17, Your Federal Income Tax. There's a link to that here and all these other links as well. There'll be a link to this in the description.